We see the faces live of traders at the Chicago Mercantile Exchange. You can see everyone's looking up at the board because the Fed doesn't have a specific time when it announces its decision. It usually comes sometime around 2:10, 2:15. We're getting very close at 2:18:11 on my Bloomberg TV screen.
No change, Kathleen, no change. The Fed funds rate remains at 0.25%. No change in language when it comes to the purchase programs or in the timeline either. The Fed will purchase a total of up to $1.25 trillion of agency mortgage-backed securities, up to $200 billion of agency debt by the end of the year. Also, the Fed will buy up to $300 billion of Treasury securities by autumn. Again, no change in language or purchase program amounts. As far as the interest rate timeline, again, no change in language. The Fed continues to anticipate that economic conditions are likely to warrant exceptionally low levels of the Fed funds rate for an extended period. As far as the economic outlook, the pace of economic contraction is slowing, says the FOMC. Conditions in financial markets have generally improved in recent months. Although economic activity is likely to remain weak for a time, the committee continues to anticipate that policy actions to stabilize financial markets will contribute to a gradual resumption of sustainable economic growth in the context of price stability. Finally, on inflation, the prices of energy and other commodities have risen of late. However, substantial resource slack is likely to dampen cost pressures, and the committee expects that inflation will remain subdued for some time. Again, no change in either the Fed funds rate or in the amounts of the purchase programs by the FOMC. Back to you, Kathleen.
Lindsay Aaron, thanks so much. We're going to go quickly to markets editor Andy Cinco for a look at the Fed effect. Andy?
Kathleen, the stock market effect so far is rather muted. We were up 12 points on the S&P 500 just before the Fed announcement came out. You can see it's right at 12 points. Not much of a move in the S&P. Let's take it to the 2-year. We were talking this morning about this being the market where you might see the biggest reaction. The 2-year was trading almost at its session high just before the Fed came out with this decision. It was yielding 1.14%. It is now yielding almost 1.16. So we're having a little bit of a sell-off, a little bit of a move up in yields, but I don't want to overemphasize that because it's not that big. 10-year, let's take a look out farther on the curve because that talk about inflation is what is very important here to the 10-year yield. Now, it was at this session high, Kathleen. It has since moved back into negative territory. So it had a rally, and now we're falling on the 10-year. It is yielding 3.63% as we speak. Just before the Fed decision, this was yielding 3.57. Again, not an enormous move, but a move. Let's just take you quickly through oil and the dollar. And here again, oil is lower by ever a small smidge here, Kathleen, 24 cents or so at $69 a barrel. And then let's take a look at the dollar. It had been at a session high, interestingly, Kathleen, because there was perhaps some expectation that they might raise rates and that there might be some reason to move back into U.S. assets. That has since pulled back a bit. Here again, not an enormous move, Kathleen. We're at 80.20 on the dollar index, which is the dollar against a basket of other currencies. Kathleen?
Okay, Andy Cinco, thanks so much. And it does look, when you sort it all out, that the bond markets had the biggest move. Not big, but certainly something. Mark, let's see what someone at the CME makes of it.
Kathleen, thanks. And let's go back to independent trader Jeff Carter from the Chicago Mercantile Exchange. And, Jeff, we were talking before the break, not necessarily expecting any surprises, but no change. Your reaction?
Well, I think, you know, your previous reporter said it all. There is no reaction here except guys reaching into their pockets and calling courses to make tea times because they were all expecting some stuff to happen, and I think now you can start playing golf the rest of the summer. So I think you're going to see a little bit of profit taking in the S&P because they were bid up all day on the expectation that there might be a little bit of a rally because they've rallied 2.5% virtually after every Fed meeting. And so you might see some profit taking there. You might see the bonds start to ease a little bit. There's one good trade that you might be able to do if they give it to you, and that would be buy the front end, buy the long end, and sell the middle of the curve if they give it to you. But it doesn't look like that's going to happen today. And the dollar really hasn't moved either. So There's really not a lot of reaction here. It's pretty sleepy. And like I said, guys are making tea time.
Well, you did say the devil's in the details earlier, and part of the text says the committee expects inflation will remain subdued for some time. Does that give you pause?
Right. Well, no, not at all, because I think they're right. I think that the primary concern still is deflation, and I think deflation is a lot more insidious than inflation. And the housing market, to me, while people have said that it has bottomed, I'm not so sure that it has bottomed. And the other point to make is unemployment is still on the rise, and net saving among Americans is on the rise. So if people are not saving, they're not spending, which again leads to more deflationary pressures. And I think the Fed is right to combat that, because one of the mistakes that Japan did was every time inflation sort of started, they took their foot off the accelerator. So a little bit of inflation is good. The question that is everybody's mind is, once inflation starts, how does the Fed dampen it so it's not runaway?
And Jeff Carter, we're going to have to leave it there, independent trader at the Chicago Merc. Kathleen, back to you.
Mark, thanks so much.